Good morning, good afternoon, or good evening to our listeners from whatever time of day or time zone you are checking into this next episode of the Gespräch podcast series by Wyden, the digital assets trade lifecycle infrastructure provider for institutional and regulated financial institutions. My name is Stuart Peterson, and I'm your friendly host of the Gespräch. Now, launching a digital asset offering from scratch is a topic we've touched on in a previous podcast. In fact, it was our very, very first episode of the Gespräch where we met with René Langer from Lützener Kantonalbank, who spoke about this topic from his bank's perspective. However, that was nearly a year ago, and now things have moved on at pace since then. The EU's MiCA regulation is now in force, bringing stringent requirements for banks serving their EU customers, and institutional adoption is clearly heating up. This results in a flurry of new business models and ways to integrate blockchain and digital assets into the banking and financial services landscape. So this time, we're going to be bringing in a different expert perspective of that specific topic of launching a digital asset offering from scratch. Dr. Ante Plazibat is head of emerging business and digital assets blockchain at core banking software provider Finnova AG. And he brings a wealth of expertise and experience in supporting banks as they seek to integrate their digital assets, having covered every element of the launch process and the myriad of considerations that are to be involved. Together with his co-authors, he has also captured his experiences in a book entitled Digital Asset Services in Banks, where he shares his insights and experiences on how to prepare a bank for the future. So, Ante, I'd like to kick off by asking you to give an introduction to both yourself and Finnova, and to provide some insights into the services you and the Finnova team provide to your banking customers. Welcome to the Gespräch, Ante.
Hi, Stuart. Yeah, thanks for having me. Finnova is a core banking provider. We serve around 100 banks across Switzerland, mostly cantonal regional banks, but also private banks and digital asset banks. From payments, investing to financing products, the whole plethora of services kind of. I've been here now for the fourth year and trying to enable banks to get started with digital assets. Before that, I did my PhD where I analyzed the impact of blockchain on the financial services industry in a holistic way. So from strategy over processes to the system layer. And here I'm happy to apply all those theoretical insights into practice and kind of help banks to get ready for this hybrid future where banks can play a role in traditional financial networks and also in blockchain-based financial networks.
Thank you, Anton. I think that's a very, very important point, which I hope and I'm sure will come out in today's podcast. So anyway, thank you for that introduction and to explain how Finnova meets with the needs of its institutional banking customers. But let's kick off and start by asking you to outline the key strategic considerations that banks need to evaluate before launching a digital asset offering.
Well, I just mentioned, I think the future is going to be hybrid, maybe not in 2 or 3 years, but especially in 5 to 10 years when we have digital assets, tokenized assets, stable coins will evolve. We will have maybe some loans on smart contracts in the DeFi world. So when we consult other banks or when we lecture about this topic, it's always about the long term, the midterm, and then also short term gain. So strategically, you have to really communicate to the stakeholders and to the C-level what's the role of the bank in the future. Right now, you start with trading and custody, but how does a hybrid future look like? There will be value propositions which won't be there anymore. You don't need a correspondent bank to forward payments from A to B, and you don't need a custodian which safekeeps securities. But there will be a new role in this new world. You will have gatekeepers into the DeFi world. You have liquidity providers. So banks can take on different kind of roles. And having the long-term vision is kind of crucial, and looking what's your future value proposition, and then coming to the short-term vision strategically, how do we make money now? So you can obviously paint a picture about the future, but stakeholders want to make money now and want to have impact now. And this is, having the long-term view, but also paving the way how to make money now. How do the services look like on the strategy process and also system layer? That's kind of the most important strategic considerations, I would say.
No, thank you. And I think we as a technology company, we also see that as well. It's a lot about education as much as what can be achieved now from a revenue generating perspective, but also what are the long-term goals. And I also, agree that TradFi and digital assets will coalesce, but they will also be in a hybrid mode for some time to come as well. So moving on, what would you say would be the biggest challenge when banks actually make that decision whether to enter into the digital asset space or not? Is it more regulatory? Is it technological? Or is it actually the demand of customers in the market?
Well, you mentioned that. I think as a technology provider, I can also state that technology is there. We have standards. Finnova is highly integrated also with Widen, so there are automated processes. So I would say technology is not an issue, and neither is regulation, because FINMA is really proactive towards the regulation. Germany has done it as well, maybe with a different approach towards tokenized assets, but also the EU in general. Market demand is also there. We've seen with FTX what happens if people store their digital assets in not so highly regulated venues. So people are getting accustomed to having and wanting to buy digital assets. So I would rather say, as you said, it's more internal barriers. So having the know-how. So having the know-how to really do those projects, having the vision and not only starting just right away with an offering. Those are the barriers, and also enabling everybody. Those teams are quite heterogeneous. You have representatives from C-level, you have product managers, you have IT guys, and they have to be on board. And complacency might also be an issue. So it's a mix, I would say, between complacency, it's fine for now, and also maybe missing know-how. And it's about really communicating the vision and getting know-how into the company that they can strive on their own, and that they can really generate value with digital assets in those projects.
I think that's absolutely correct. And some of the things that we see, in different sort of areas, countries or jurisdictions, you have, different sort of segment focus as well, whereas, for example, in the EU, there's a big trend towards retail go-to-market, where the closed loop buy, sell, hold, whereas somewhere in, like, for example, Brazil, you're seeing much more institutional go-to-market strategies for prime services or prime brokerage. So, in terms of these focus segments, for example, retail, private banking, or commercial, what do they play into the considerations and approaches in terms of launching a digital asset offering? And then what are those potential differences between retail and private banks as well, from your perspective at Finnova?
But Finnova, I would say we have mostly private banks and retail banks. And there you can see that they start in the same manner. So usually you start with a processor or a partner bank where you do everything in a sourced manner. You source your trading, you source your custody, and it's just to get started. It's for the time to market purposes. But then what you see, it's a bit cliche, but usually in private bank clients are fewer, but they have higher amounts of money they want to put into Bitcoin. So for private banks, it's custody which comes first and what they prioritize. So it's getting, increasing the asset under management, asset under custody number is quite important. Whereas with retail clients, you have more clients, but they're investing fewer francs into digital assets. But there you make money more with trading fees, for instance. So what would then happen is that the retail banks prioritize to internalize trading activities. It's kind of easy. You can use an order and execution management system like Widen, and the delta towards your traditional business is not so high. And private banks rather first focus on internalizing custody because they make money with the custody fees. And it's a capability close by to private banks where they know how custody looks like, compliance around custody. So internalizing custody for retail banks who do not have a position in traditional custody spheres, it's hard for them because compliance, transfer in of cryptocurrencies is a big topic. But we've seen also the other way around. If you look at Luzerner Kantonalbank or Züricher Kantonalbank, they actually start with custody. So obviously you have those schemes where you say usually retail banks tend to do this and this, but it's also an opportunity. Right now, in the traditional sense, it was hard for a bank to become a custodian. There are high entry barriers, but to become a custodian now in the digital asset sphere is quite easy. Obviously, you need a custody system, but the entry barriers and the costs are nothing compared to becoming a custodian in a traditional financial network. And therefore, you can see with LuKB and Züricher KB that they are really pushing into custody and seeing the potential there strategically. And this is why there's no silver bullet. But usually, as I said, retail banks internalize trading and private banks start with internalizing custody.
Yeah, absolutely. And I think that presents a business opportunity that's very different to the traditional finance industry, because, you've kind of got traditional banks or cantonal banks that have been known in one particular area, but actually their go-to-market opportunity to take advantage of digital asset technology and digital asset products and services can actually get them to market quicker and be different and, differentiate themselves from other retail banks or cantonal banks. But, every bank needs to make a decision about where and when it goes to market. And there's obviously some common mistakes that banks make. So in your opinion, what are the core areas of, mistakes or thought considerations that banks either make or need to take into account when assessing, should we go to market in digital assets, and where do we start?
I think a lot of banks do it right, because they look at, okay, what's my future positioning? I just mentioned two example. But often it's also, I say the biggest mistake is always to have reactive versus proactive behavior. So there's a market demand, I have to react, and I go with a source model and I try to offer the services as fast as possible. But defining this vision is also key for change management. So what is my role in the future? And also designing an architecture and a business model which accompanies you for your short-term goal, but also for your long-term goal. And a bank came to me and said, okay, I started now with trading, but what about staking, transfer in? What about all those use cases? And I think about those additional services after 2 or 3 years. And this leads to the fact that some of those banks have to reiterate their reference processes, their reference architecture, because they didn't think of that beforehand. And this is why I would still say, you can react quite fast. You can you can find a bank you can partner with and just start with a service. But taking the time to look at your long-term strategy and how those different building blocks would look like and what's the requirements to your business and to your IT architecture, doing that in the beginning helps you in the long term. So I would say that's one of the biggest mistakes, that you just react and you don't think about what's my path and how do I get from A to B to C.
Yeah, absolutely. And we're definitely seeing a lot of banks, particularly in the European Union under the new MiCA regulation, thinking about what is the long-term goal. And a lot of them express an interest or an opinion that they want to be able to offer the ability, what we call open loop, where customers can transfer assets in and transfer assets out. But because of the KYC, AML, KYT requirements of MiCA, it's a big burden for them. So therefore, they want to be more sort of tactical with their go-to-market and offer these closed-loop services. So I think they are thinking about where they want to be, but areas of sort of lending and staking is very much a new world for them. But for trading and custody, they can get their heads around that in that respect. But if we sort of move on now, for banks, they want to be able to integrate digital asset services into their existing brand and services. But how does that work in terms of maintaining cohesive brand culture? You're seeing a number of banks go to market with their own name or with different names. And of course, then you have the different sort of services that they offer as well.
It depends. So the different approaches of how to deal with digital assets. Some banks or core banking providers build a new digital asset module, and it's a whole topic on its own. We at Finnova, and I think this is one of the common ways to go, integrate it into our traditional banking operations. So obviously, if you define just a new asset class, and if you try to adjust digital assets into the existing processes, the customer experience is also similar. So it really depends on how you view the digital assets. For us, it's just another asset class. And then you obviously, when it comes to the brand, it depends. What do you want to achieve? If I'm a fast or late follower, and if I just want to keep up with the market demand, I don't need an extra brand. I just slowly iterate new innovations. Now I can buy a Bitcoin over my trading module, and everything is okay. If the bank wants to position itself in the hybrid banking world in a different way without jeopardizing their current brand and their current reputation, it might make sense to also create a new brand. And in the future, maybe right now, 10% of the revenue is coming from the new brand. But as hybrid banking evolves, more and more revenue will shift over to this new brand. And it really depends on what's your goal. As a late follower, you can just integrate it into the existing customer experiences. If you want to see yourself diverging, maybe going to another path and seeing other value propositions in the digital asset space, it might even make sense to create a new kind of subsidiary. So this is kind of the outside in view, but also the inside out view is, are you capable as a bank to run innovation in a fast pace? So how does the organizational structure look like? How fast are you able to iterate within your existing processes? So there are different factors to consider when it comes to, okay, do you want to expand your current brand or create a new brand on the side, I would say. Both approaches were totally okay.
No, I completely agree. And we've definitely seen, that both models where the bank has used its existing brand and infrastructure and name to offer digital asset services, and then you've also seen new products and services offered by banks such as Société Générale with SG Forge, and there you've then had Bank Archai having its Tradias brand as well, and there are numerous other examples of that in the market. But I think it's also down to where that bank, how old it is, how strong the brand is, how much it wants to have brand protection around this new paradigm or asset class or infrastructure or model that we call distributed ledger technology. So I don't think there's a one size fits all. I think that actually it comes down to the bank and its brand and its marketing and its board of directors to actually decide whether they have a separate brand or whether they subsume it under the existing brand infrastructure. Yeah, so maybe let's move on a bit and look at some of the differences between retail and private banks. I think we touched on it a few minutes ago, but let's just take, for example, high net worth customers. You mentioned them earlier. There's a big focus on maybe custody as opposed to trading. But how ready are, for example, the high net worth customer segment? How ready are they to actually embrace digital assets? And I'm sure from Finnova, you service Swiss banks, and obviously a large part of that customer base are HNWs.
Coming back to FTX, so we've seen a lot of inflows coming also from banks and financial institutions outside of Europe. So in 2021-22, we've seen that. I think Signum alone had inflows in one quarter of around 800-900 million. So those high net worth individuals, they already had some Bitcoins, not all of them, but they invested in that. They knew it's a volatile asset class, but they were okay to take the risk. And they want to safe haven, or they want to safekeep their assets within their traditional private bank environments. So I think most of them are actually ready. First of all, they start with execution only. And this is also what one CIO of a private bank told me, that if they come to the bank and demand a transfer in, then obviously the banks have to do it because it's a great business model around it. But they're not advised, or they're not marketing it proactively. So if they're coming, they're doing it, and then they do execution only. And this is also changing. I think in the future, banks really have to keep up with building up advice competences and not only offering execution only, but seeing it as an asset class, advising on it, on the pros and cons of it. And this is why I would say really, even in that space, it's a highly interesting domain. And we are now shifting from execution only and offering transfer in services to more and more advice towards those individual clients.
These customers, whether they're high net worth individuals or whether they're retail, we've seen over the last 5 years, 3 years, 2 years, even the last week now, right? By the way, we are in the into second week of April, wherever you're listening and when you're listening to this podcast. We've had huge market volatility over the last few weeks, really driven by geopolitical views. You mentioned FTX. We've had a lot of bad actors. That's kind of being weeded out of the industry as the industry matures, which is a great thing and happens to all industries. But we still have customers who have those concerns about security of their assets, right? Those assets being stolen, or volatility of the assets. So should I be in Bitcoin or Ethereum? Should I be out? So how do you think banks should address some of these concerns?
I mean, when it comes to security, there are also different layers of security. You have obviously security relating towards the asset, but also towards the underlying technology and protocols. And some of the elements you can steer as a bank, and some of them you can't. So when it comes to choosing the right counterparties, when it comes to choosing the right custody systems, those are the things a bank can proactively do. And then the bank is or has to communicate transparently what about the risk with blockchain protocols. So there are forks, there are vulnerabilities in the protocols, there are smart contract risks, then there are also risks regarding the assets themselves. And this is something banks have to do the research on. So what's the difference between a Bitcoin, Ethereum, Solana protocol? What about the coins inside, the consensus mechanisms? And what we can see there also, the sector is maturing. There are also right now insurances covering also or offering insurance services towards or against smart contract vulnerabilities and exploits. And this is what you can see with the life cycle. Usually you have a technology, is nascent, then some people build services around it, but the real big enterprises join this sphere when there are also insurance services covering some of the aspects and covering those risks. And banks have to obviously insure against some of those risks and vulnerabilities. They can't do it against all of them. Some of the risks they can actively manage, and some of the risks they have to expose transparently to the customers in stating there are risks of slashing in staking. There are risks of smart contract hacks and forks. And you have to convey to the customers those risks. And customers are also used to risky asset classes. If you buy a small cap share, it's also the same. So just communicate it transparently that you did your job and let the customer decide. And when it comes to volatility, as I said, you can right now invest in small caps. It's not a big issue. Volatility can also be good if you look at diversifying your portfolio. And volatility can also be good if it's not correlates to the volatility of the traditional market. So can you also use it as a hedge? So we can do back testing. We can show how Bitcoin has performed compared to traditional assets. You can outline this, and ultimately it's the risk appetite of the customer, because they are high risk but also high rewards, and this is what makes Bitcoin also so special. And it's still only for the cryptocurrencies, right? As soon as you talk about tokenized assets, etc., this volatility goes down. So for this specific asset class, there are risks but also high rewards. If you communicate it, that's totally fine, if you ask me.
Yep, absolutely. I completely agree with you on that. So as we're looking at more sort of retail banking, there are many different sort of customer segments in retail banking, and therefore banks are looking to sort of package and build and offer different kind of products and services around digital assets, whether it's custody, whether it's trading and execution, whether it's staking. But maybe could you sort of touch on some of the points that you think for each of those, what we call personas, be a retail customer or a private or a high net worth individual? What should some of the banks think about when they start to build and offer these and package these products and services? Let's start off with retail customer.
Yeah, we spent quite a lot of time defining the perfect persona for retail banks. Because for the younger generation, they're directly jumping to Revolut, to Kraken, to Coinbase. So they're open to offer, to try out new kinds of applications. They really value customer experience. So our retail banking persona who really uses the services from a retail bank or a cantonal bank is a bit older, is 40, 50 years old, maybe a beginner, late when it comes to the market. So it heard about it in a bar. It also wants to buy Bitcoin, but in a convenient way. So this persona doesn't want to do a transfer out to a crypto exchange, do a light KYC, buy the Bitcoins there. And then what about tax returns or tax statements in general? Then you need to download Excel files from different exchanges, send it to your accountant. So this is really inconvenient. So our persona is more than 40 years old, is new to the investing sphere and wants to do it in a convenient way because there's still FOMO. Everybody talks about it. And if you buy it, it has to be from your main bank account. Your salary account is there. You can do it in a convenient way. You can later have a coherent view on your portfolio. As I said, Bitcoin is just another asset class. You can do a tax report and it's everything in a convenient way. And then the customer is also willing to pay extra for that, for this convenience. But the misconception is really, I would say that it doesn't make sense for the retail banks to focus on Gen Z because I think this is a fight you will really lose.
Absolutely. And what about sort of private banking, high net worth individuals, right? As you mentioned earlier, some of them, have already transferred Bitcoin into Switzerland from outside. So a lot of them have already, they're high net worth. They've probably got advisors and they've got experience of a highly volatile asset class or sector. So what would you sort of look at in terms of those types of personas and therefore product packaging?
There we have quite a few, 3 to 4. Maybe I can point out 2 different ones. We have the diversifier, who just sees a potential also in Bitcoin as an asset class, who puts maybe 5, 10, 15% of his portfolio, invests it in cryptocurrencies. And he's okay with normal services. So as I said, he wants a portfolio, he has his portfolio tools, and he's happy with it. He's just using it as a diversify mechanism. Then you have the crypto believer, who says all the way Bitcoin long and fiat short. And he wants to use additional services. For instance, he wants to use crypto-backed loans. So he's using Bitcoin as a collateral, and then he's getting fiat because he thinks that in the long run that crypto will outperform fiat. And he wants to do transfer in. He wants to do staking. So this one already bought cryptos before. He's really believing in it. And he also wants the private bank to not only safekeep it, he wants the private bank to do transfer ins. He wants the private banks to offer additional services, like, as I said, loans with crypto as a collateral. He wants to do staking, and private banks have to be ready for that because it's a huge market segment, which is also rising. And if you're not satisfying the clients with those value-added services, then you will lose this crypto believer.
Yeah, absolutely. We have these different sort of segments and different personas as well, whether I'm a newbie 40-year-old in retail, or I'm a diversifier, or I'm a crypto believer in the private HNW sector. There is so much information out there where, different websites, different commentary and information, you get overload. So where do you start? So for me, information is nothing unless you have education. And therefore, what do you think about education, and how can that play a pivotal, vital role in, the growth of digital assets?
For me, that's the most crucial element, and it really comes back again to change management 101. Create a sense of urgency, communicate the vision, empower employees, also the customer. You really have to take care of those misconceptions. And when I also lecture, when we advise banks, I always ask the question, how many percent of transactions on the crypto space are bound to illicit activities? And when I ask, for instance, the students, they tell me 20, 30, 40%. And when I ask them, what about fiat money? They tell me, yeah, maybe 1% or 2%. And it's actually the other way around. So if you look at the Chainalysis reports, right now we have, for the past years, below 1% of crypto transaction being bound to illicit activities. And actually the UN says that 2 to 5% of fiat money is being laundered and is being used with illicit activities. So first of all, saying, okay, Bitcoin is not bad, is actually better than the fiat system. To start with those misconceptions, it's really the first thing you really do to educate and to have this paradigm shift towards somebody's perception of the whole industry. And then when it comes to those investors, you have FOMO, you want to invest, but maybe then you go through a bear market or a bull market, and then you're asking questions, right? So banks should really also kind of set up a portal, or when we do it now with the smaller cantonal banks, before you invest in crypto, there's a page about all the information you need to know. What is a protocol? What is consensus mechanism? How does it work? And in the beginning, it might not be so interesting because banks just want to be part of the hype and just invest in it. But as you go through this volatility and those cycles, retail and also private customers question what's behind it and want to know more. And therefore, banks should be able to also communicate all those information around it and make sure that it's not something you find on Google, but it's aggregated in a convenient way and that people can consume it and understand it while they're right together with their Bitcoin portfolio, hopefully in the long term.
Absolutely. And I think that there's some really great insights. And, for private banks, for retail banks, for the banks that Finnova actually provides some services for, they're all regulated, right? Which is the paradigm shift away from the original inception of, products and services offered by, unregulated institutions. So maybe let's switch gears now and move on to discussing that very important topic for regulated institutions, which is actually regulation. And let's maybe look at some of those regulatory perspectives. So when comparing Switzerland with the EU, with the new MiCA laws that have just come out at the beginning of 2025, what do you see as the main differences in how they approach digital assets? And do these differences affect banks, in their planning to offer digital asset services, maybe across both jurisdictions?
There are some differences and there are some similarities. I would say the main difference is that the FINMA approach is kind of principle based and it's more agnostic. So you don't define specific technologies for specific use cases, whereas MiCA is really, really much more specific when it comes to, okay, you have to use those kinds of systems. And the TLT is that so it's incorporated within the traditional laws, whereas MiCA has kind of a new set of laws and regulation. So it's easier for traditional players within Switzerland to offer those services. Getting those licenses is also kind of easy compared to you need special licenses for any kind of token on the MiCA regulation. So that's the first thing I would say. It's easier for Swiss players than under FINMA law. Then obviously in FINMA differentiates between the payment, the utility and the security tokens, whereas the MiCA approach is slightly different. You have, I think, two different tokens focusing on stable coins, where you have the asset reference token and the e-money tokens, where one of those ones is a one-on-one peg to the fiat currency as an underlying. The other one can also have commodities and an underlying. Then utility tokens are kind of the same, but security tokens are handled under MiFID II, which is, again, a different law and different section. And this is why I would say even then in Switzerland, it's easier if you want to offer services and offer payment services and security services. It's under one umbrella. Whereas now with the MiCA regulation, you need specific licenses and a specific regulation based on the different token types you're having. Plus the fact that if you want to offer services as a Swiss institution in the EU context, you need an entity or legal entity within the European Union and those licenses. And the other way around is easier. So right now, European bank can offer services to FINMA. So I would say it's much more open in Switzerland. It's more strongly regulated under MiCA regulation, and it's harder for us to go to Germany than for Germans or Europeans to come to Switzerland and offer their services. In a nutshell, that's kind of the main difference I see there.
I definitely agree with you that where we see a lot of banks getting their MiCA licenses clearly under Article 40 of MiCA. Article 60, you can apply for the 40-day rule if you're already a regulated institution, but you still need to prove both MiCA compliance and also DORA compliance as part of that process as well. Now, if you're new into the market and you have to apply for a MiCA license, it's quite prescriptive in that respect. And I'm sure that in Switzerland, obviously it's a little bit more relaxed, as you said, it's principles based. But then moving on, maybe another area to consider when a bank wants to plan its go-to-market strategy and to offer those products and services to retail or institutional clients is as you mentioned earlier, the technology. What is the actual technology that would be required to be set up and implemented by a bank to ensure that they can actually securely meet the needs of their clients and the products and services they want to offer? So, Ante, when it comes to the actual implementation of that technology, what are those key technological factors a bank must consider when developing and implementing a digital asset infrastructure?
I mean, first of all, you have to get your core ready. So there are adjustments. You need maybe new asset classes. The core has to be highly available. So if you have an old monolith, you have to innovate on your core, get some of those business logic on a container in a hyperscaler cloud. So besides having the core ready, the centerpiece is the custody system, because there we have the paradigm shift in a core banking system, which is the golden record. You keep track of the traditional assets. But if you keep track of the digital assets, it's over the custody system, and the golden record is actually on the blockchain. So interfacing between the custody system and the core banking system is really crucial, and automating this interaction. Then obviously you have the order and execution management systems such as Widen, which helps you like placing trades and also life cycling all the different execution venues you're having. And then also compliance software and compliance tool like Chainalysis, Elliptic, and they make sure that if you do transfer in and if you have coins, that they are not tainted, and you can also have them in a compliant way. So the interplay between core, custody, order and execution management system and compliance system will be crucial for the bank of the future, the hybrid bank.
Absolutely. I totally agree on that. And so with the market maturing, do you see there's a certain sort of standard trading model set up or infrastructure set up that's now being applied? And if you do, what do you see in terms of benefits of cost, time to market, and also in terms of revenues, which is obviously the most important thing for a bank, because if they don't drive revenues, what's the point in doing a new product offering anyway? Do these actual hot setups provide?
Yes, I would say so. So as I said, usually you start with a source model where you don't have to do that much as a bank except sending out an order and doing the reconciliation. But if you internalize trading, then how you would set up is, because first you have a single broker strategy. You have one counterparty, and then once you have an order execution management system in place, you can then also have execution venues like exchanges, like Kraken, and then also execution venues like highly regulated brokers. So if the market is totally okay and moderate and there are no ups and downs, then you can easily buy over an exchange, over Kraken. And then you get much more margin compared to, for instance, going over Signum as a counterparty. But you still need those lifelines. If there's a high volatility and the networks are congested, you still want to have a credit line with a broker in Switzerland. So usually I would say, as I said, the standard approach is first a single broker, but then diversify those risks, have an order execution management in place, then also having exchanges in place, and there you can make some money with margins and also with trading fees. On the custody side, it's the same. You have established players providing custody systems, but there's again, once you have that in place, you want to start with partners also providing staking services. Either it's the custody system provider who offers those staking services, or it's then different providers you connect with. And then it's about staking, making staking revenue. And the more you internalize and also the more you manage internally, the higher obviously your gains in the long term.
Absolutely. So if we look at the fact that, a bank go-to-market would obviously need its core banking system for its IBOR or system of source of truth of records. You've got the customer management, you've got the KYC, the AML, you've got the trading, the execution, the life cycle, and also very important, as you said earlier, you've got the custody side. So actually, how important is blockchain or distributed ledger technology actually to a bank today?
This also may be a misconception. As I said, the bank and the core banking system does not interact with the blockchain directly. But this is why choosing the custody system is so crucial. Because there you do the whole safekeeping of the keys. You can do it over hardware security modules or MPC, but the whole safekeeping aspect is there. Then obviously the wallet management. Then they are also maintaining the nodes and also interface to the blockchain protocols. You have the transaction policies within those custody systems, and this is why it's so crucial that you're choosing the right custody system, and you don't have to be afraid of interacting with the blockchain, but you should trust your custody system provider, understand what he's doing, because he has to life cycle all the protocols and make sure that the interaction to the blockchain is right. And then on the other hand, you have also private DLT systems. So when you talk about public blockchain systems, you do it maybe over a custody system. And if you have other DLT systems like private systems like Corda, etc., mostly national banks use for CBDC projects, there's a bit different. There you run your node, you interact with other banks, but you're not exposed to those risks because you're not in a public environment. And this is why for public blockchains, it's the custody interfacing. And for private DLT systems, the bank can do it on its own. But then you do not, that it doesn't correlate with the dangers and with the complexity of public blockchain systems.
I completely understand what you're saying and agree. But maybe just at a very high level, what are some of the sort of high level sort of functional areas or processes that a bank would need to set up and consider, such as in terms of not just trading, order execution and settlement, but also reconciliation, asset transfer, some of the things that your customers that keep them up at night in terms of those key considerations?
Obviously, it's then about, if you start with the trade life cycle, it's kind of straightforward. The trade life cycle is similar to traditional trading. Obviously, there are some differences when it comes to the trading venues. It's different because you don't communicate over fixed with any kind of trading venue. You have to make sure that you also, if you work with exchanges who communicate over a REST API, then you have to make sure that the communication always runs smoothly. And as it's not so standardized like the traditional financial industry, you need order and execution management systems to make sure that you can always have a proper connection to those execution venues. You have to manage liquidity, which is also an issue. So usually you have a credit line, But if it's about order funding and managing liquidity, there are also different means of how to do it. You can do it with stable coins. You have escrow wallets, and also being efficient in that sense that you don't have to pre-fund specific exchanges and that you have to manage your money across different venues is also a big issue. Then when it comes to settlement, it's the question of how you really net. So if you're already in a sourced model, you know that you don't make any money. And if you want to make money, you have to start netting transaction. You have to do a settlement right and also manage your risks. So there it's about really having guardrails in place, that you have a cold wallet and a hot wallet where you keep most of the funds in the cold wallet, extra secure. And I would say along the whole value chain, I think it would take too much time to dive into that. Along the whole value chain of trading and in settlement, there are specific nuances which are special to digital asset sphere, where really banks have to do their homework on how to address those challenges individually.
I completely agree, and this is some of the sort of discussions we have with with our clients and also prospects as they grow into the market. That they where do they start? What should they consider? But another important part that people ask, is around cybersecurity, right? And what should they be doing around that? And what should be their design and rollout of cybersecurity?
Yeah, it's an interesting topic because we have a lot of new innovative ideas around cybersecurity, because when you talk about the custody system, as I said, it's kind of the centerpiece. And how do we make sure that blockchain transfers are always valid? And if we want to do now a transfer out of a customer towards an external wallet, for instance, then you have to make sure that those transaction policies which are in place in the custody system are aligned with the transaction policies you would usually have. And maybe there are specific policies you want for digital assets. If you want to transfer, let's say, for instance, 5 Bitcoins or a lot of Bitcoins, then you can state in those transaction policies that different people have to sign it. And then the question is, okay, how do you sign transaction and how do you safekeep those private keys? And then obviously you have the traditional way with hardware security modules, where you have really a physical server in the seller, and there you can say it's really, really secure, and even maybe more secure than traditional banking, because you have those transaction policies. You have to be physically in the building to put your smart card in to try to sign a transaction. And then you have obviously the more innovative phase of multi-party computation, where specific compliance employee get a push notification within their app. And if 3 or 4 persons have to sign a transaction because it's above 100,000 francs, then they have to do it. And everybody has a just shared bit of the private key and is being then composed and signed. So from this perspective, setting up like proper compliance mechanisms, proper policies within the core banking system and with the custody system, taking care of private safekeeping. If you look at it all together, then it's kind of a secure element from what you can proactively manage. As I said, there are mitigation plans. If there are vulnerabilities in the protocol, then the bank can't do anything. And for that, it's maybe reliant on external insurers for those cases. But I would say that it's really, really secure, and maybe even more secure than traditional processes, because it comes with this extra security features, and especially hot and cold wallets. So a warm wallet is a wallet which is always connected to the internet, but you have some transaction policies in place. But a cold wallet is totally separated from the internet. So you can say you curate 2 wallets where on the warm wallet, it's only 5% of your whole liquidity, and most of the liquidity is safe in the cold wallet. So to get money out of the cold wallet, as I said again, some people have to go into the bank, have to get the access card, have to sign a transaction. So it could be even more secure, because if you go to the bank and rob the bank, the money is in the vaults, and there the access to the HSM is physically there, and you can still not access those Bitcoins. So I would really say a lot of that is evolving, and also if you set it up right, then it's kind of really risk averse. All those guardrails along setting up a secure custody system.
And there's some absolutely awesome insights, and particularly if I'm listening to this and wanting to think about go to market and what do I need to do, there's some great thoughts and perspectives. So thank you very much for that. If we turn now into more back to you and Finnova, right, in terms of core banking or core banking systems, what would you say that those CBSs need to actually do to evolve, to actually take on the gamut of requirements for digital assets? Are there any sort of specific opportunities or even challenges for traditional core banking systems?
So when we started, we already had crypto banks such as Signum Bank or Incorp Bank who already offered services. And we started really with setting up, as I said, those asset classes. So some of the banks used, I think, a token as an asset. Other banks used precious metals and changed them to Bitcoin. So creating standards in terms of asset classes was kind of the first thing we did. Then the second most important element was clouding those pending settlements. So when you trade, obviously you have an execution, but at some point the asset arrives under the bank's custody, and then the core banking system has to know when to close the open pending settlement to finish the settlement cycle and to do the reconciliation. So in terms of security and compliance, the most important thing was to build this interface that you can communicate between core banking system and a custody system, and that the core banking system knows when the wallet arrived. Then it's about, obviously, near-time pricing is important. You need at least real-time or near-time pricing. Having those old prices on the e-banking is not something a customer wants from a customer experience point of view. Then when you start with additional services, let's take staking for example. So how we solve the problem of staking and allocating staking rewards to customers is not reinventing the wheel, but looking at what kind of corporate actions are there. You have the dividend payments, for instance, where you have an asset performs in a way, and if you have a share, you get a dividend payment. Now with staking, it's kind of similar, but a different analogy, because you have one asset as well, Ethereum, but then you have n different validators and staking pools who then perform to m different or who allocate their revenue to m people. So instead of having a 1-to-n relationship, one asset and performance is always the same. You have the 1-to-n-to-m relationship where different validators and staking pools perform in a different way. So then using those corporate actions, seeing which corporate action is the closest to the mechanics of the blockchain activity, and adjusting this is something we work on right now, for instance. Then if we look further, what about stable coins? Usually we use digital assets as securities. Now stable coins should be a currency, because then you can do delivery versus payments. So getting the depiction of stable coins right is something we work on. And then once you go to financing, what about loans and smart contracts? How does this work? So there's plenty of work to do, but those were the steps we kind of worked on in the past 3 to 4 years, slowly getting the core ready for those kinds of services.
What you're effectively saying is, even though people perceive it to be a different asset class, it is a bit of a different world as well. That not just in terms of products and how, the behavior of those products, but actually the technology behind it to make it work properly as well. It's also a paradigm shift. I think it's always good practice on a podcast to ask our guests to provide some thoughts and insights on the future outlook. So Ante, what do you see as the potential 2 or 3 major next trends in digital assets and in digital asset banking? Or rather, on this, maybe even on the system or process level?
This is actually also a question we ask in the book, where we interviewed different kind of banks along Germany, Switzerland, and Austria, who went this hybrid way. So those banks have a role in traditional banking and also in blockchain-based banking, where they start with those services. And the answer was always quite similar. So you start with the investing domain, where you just use it as an asset class. But now we see a lot of momentum in the payment domain with stable coins. And then it's reciprocal, right? So you have delivery versus payment. So first you buy the Bitcoin, but you have a fiat leg. But if you then buy Bitcoin and pay with stable coins, you can even have atomic swaps at a certain degree. So for me, the real beauty comes into play if you do not replace a specific banking silo, but if you use the synergies. We have maintained in the past a payment network where different players, where you have correspondent banks, etc. And we have a securities network where you have CSDs and custodians. And once those networks merge and we have specific different kinds of tokens playing with each other, that's where the real beauty of blockchain come into play. And this is why I think it's an evolutionary approach of now in investing. We can buy and hold cryptos. In Germany, you have more the approach that you can tokenize traditional assets. So they start with the tokenization of the traditional assets. Then you have delivery versus payment, where you get the fiat leg also in the blockchain with stable coins. And then at some point, you also have the smart contracts, where, Signum is already doing it. First, you have a crypto-backed loan, but this loan is paid out in fiat on a physical contract. Then at some point you will pay out in stable coin, and at some point this contract will also be a smart contract. So also going to the financing domain and slowly iterating those innovative steps in how to give out loans, how to use collateral, is going to be the third step. So over the investing domain, through the financing domain, up to the payments domain, and to the financing domain. This, I think, will be the developments we will see now in the future, and having the reciprocal benefits of those domains working together.
That's a lot for people to consider, Ante. I much appreciate all of those that stellar commentary and views you've provided to our listeners today. And I'm sure you've given them a lot of food for thought, right, from this edition of the Gesprochen podcast. The market's moving very quickly. It's also maturing. And therefore, as I always say, and it's also very important, it's not just our guests that make up a podcast series very, very successful. It's also you, our dedicated and loyal listeners. So if you continue to like what you hear from our podcast, I'd really appreciate if you can spread the word and amplify the message, then that we could then get even more institutional focused people and enjoy everybody's experience of growing institutional adoption of digital assets. I obviously like to thank you, Ante, for your time today. It's much appreciated. We really appreciate having really insightful guests on the Gesprochen. It makes the whole series very, very important for us, and obviously makes it successful and allows us to grow our listener as well. So we'd love to have you on in the future. Maybe we can ask you to come back in 9 or 12 months' time, and then we can look at the evolution of the core banking market again and actually do a bit of a mark-to-market delta analysis as well. But at this point, I'd like to thank you, Ante, and all of our listeners for attending today, and enjoy the rest of the day wherever you are. Thank you.